Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. And I'm bringing you another Subscriber Tuesday video that I think is going to be very interesting for you because, one of the things I talk about, I'm also known as Mr. Valuation. I'm always talking about valuation. And of course, valuation in today's stock market, which in my view, as I'll show you here in a moment, is highly inflated, is very, very difficult to find. But I also like to point out over and over again that it's really a market of stocks and not a stock market. So, rather than worry about what the market's going to do and rather than try to think about things like holding cash, waiting for a market crash and, things like that, I think it makes a lot more sense to try to look deeper into the markets and try to find value wherever you can. Now, especially for the dividend growth investor, the highest quality dividend growth stocks, technically the majority of them, not all of them, but the majority of them have become overvalued in this market because interest rates, as we all know, are still hovering around all-time lows. The reality of that is there's talk about the Fed maybe raising rates next year, so that kind of gets a risk to the market and a risk to those overvalued stocks, I might add. But the real point is, the market is going after quality right now. The highest quality dividend growth stocks that you can buy, therefore, have been run up in price, which gives them lower yields than you would get if you bought them at fair value, and also less long-term opportunity, less of an ability to participate in the growth of the business, which I think is a critical aspect of why value investing is so important. But it is a market of stocks, and if you look hard enough, you can find them. Now, one of the highest quality dividend growth stock characteristics that you can look for are what are called dividend champions or dividend aristocrats and even dividend contenders. The CCC list, which is currently curated by Justin Law, originally developed by a gentleman who's deceased now named David Fish, covers dividend champions or companies that have increased their dividend for 25 consecutive years or more. That's very similar to the Dividend Aristocrats list, which also has 25 years of dividend coverage or more, or increases or more. And then the other lists on Justin Law's current list are the contenders and the challengers, companies that have raised their dividend by at least up to 20 years and then 10 years or more. And so the bottom line is these lists are trying to identify premier dividend growth stocks that have the really important characteristics for you, the dividend growth investor, of giving you a raise in pay each year. That's the real beauty of it. Now, let's go ahead and look at this. And what I'm going to be covering in today's video is a dividend growth stock called Polaris, which people have asked me to cover. I've covered it in the past. It's become very inexpensive here recently, which I'll show you here in a moment relative to the market. But it is a dividend champion that's increased its dividend by 24 consecutive years. But let's start this video by taking a look, just as a perspective check, if you will, of the overall stock market. So what I've got up here is a fast graph covering the S&P 500. Now, for those of you that aren't familiar with these graphs, let me just real quickly give it to you. I've got an orange line on the graph here, which plots the earnings per share, in this case, the index, the S&P 500 index. The white line is the dividend line, and you can see the S&P did have a dividend cut in 2009 coming out of the Great Recession. Their earnings grew and then collapsed and then grew. And then we had COVID, of course, which everybody knows, what happened with COVID. And then the earnings have been growing again. But since COVID, the earnings have grown very rapidly. The light green shaded area are the dividends that are paid out. Below this white line is the dividend payout ratio. And these are the dividends that are paid out. So the idea here is you get, two components of return. You get the capital appreciation or depreciation, which is the price moving from point A to point B, but plus you get the dividend income, which is highlighted by the yellow line. Now, this orange line theoretically represents intrinsic value, if you will, or what, the market ought to be trading at. I guess you could put it into those terms. And you can see that most of the time the market trades within a reasonable proximity to that orange line. It's not the absolute line, it's a range that you should think of, but it's kind of the midpoint of that range is what the orange line would suggest. Now, coming out of 2013, as we progressed, into 2015 and so on, you can see that the market has separated from that orange line and then become very, very overvalued. So this is a calculation of intrinsic value based on fundamentals. Another important line in the graph is what we call the normal PE ratio line, or what I like to refer to as the market value line. It's the line that dictates what the market has historically, or how the market has historically valued, typically a stock, but in this case, the index. And you can see so that, the S&P is ranging somewhere around 15 to 17 times earnings. The orange line is a PE of 15 on the S&P. The blue line is a PE of 17. And you can see now that the S&P 500 has gone way beyond that. So we have a very, very expensive market now. We have a dividend yield in the index of 1.35% and an earnings yield of under 4%. And my minimum threshold is 6.5% to 7% or higher. The higher, the better. Okay, so I'm going to go ahead and look at the Dividend Champion that I'm going to be covering today, Polaris Industries. And I'll talk more about what the company does and who they are in a moment. But what I really want you to look at is the comparison of Polaris relative to what we saw in the stock market. So first of all, we see very consistent earnings growth in the company up and through 2015 and 16. Now, what happened there was the company made a major acquisition and they had some basic charge-offs and integration costs. So they had a restructuring cost because they sold Victory motorcycles, and then they were integrating their Taylor-Dunn industrial acquisition that they made. And then 2016, as I'll show you here in a moment, just showed slightly lower sales and higher costs across the board, which happened. And then there's also some other issues which I'll talk about. But here's what I want you to really see on this graph. I want you to see the correlation of price to fundamentals and how when those fundamentals get disconnected, how they always revert back. So the orange line is your intrinsic value line. The blue line is the market value line. And we've got a pretty tight range for this company over this time frame here. So notice that when the price got significantly above both lines, it eventually came back into alignment. I'm going to argue that always happens. Then we had the Great Recession. Of course, fear reigned and people got panicked. We did have a slight down year in earnings, but still very profitable year for the company. They did, however, note, and this is very important to this presentation or this video today, they did raise their dividend the year before the recession, during the Great Recession, and the years following the Great Recession. And that'll be a function of cash flows, which I'll get into later on in the video. Okay, but then the stock did recover, and then we had these really excellent years coming out of the Great Recession where earnings growth was absolutely phenomenal, 40%, 50%, 23%, and then 22%. And of course, that created a lot of optimism in the stock, and the market ended up putting it up here at these very high multiples, 22, 23 times earnings, etc. But then along comes a flat year in 2015, followed by a negative growth year in 2016, which I've already mentioned why. And that took this vulnerably overvalued stock and then had it revert to the fair value, okay? But then we also had a drop in earnings going on. But now that's a little more onerous than it looks, because I'm going to show you that when I get into some other metrics that we'll be covering a little bit later. But then we had this strong recovery and the stock recovered. But then we had another down year. And of course, we see the stock price drop. And of course, along came COVID and the flash crash. And we had this incredible drop, which turned out to be just a magnificent buying opportunity as the company has moved back into fair value, overshot it a little bit, and now is undervalued again. Okay, so looking at it, just a brief introduction into the future here, forecasting wise, if I look at this stock from a standpoint of near-term forecasts, it has about a 12% margin of safety. In other words, right now the stock is trading at about $121 a share. That was yesterday's close. The stock is technically worth about $136 a share. That's about a 12% margin of safety. And by year end, that margin of safety would increase to about 18%. In other words, that's what the undervaluation represents for the period now where we're in the third quarter, which this is a fiscal year December quarter into the end of the year. So we've got a nice little margin of safety. We got a blended earnings yield of 7.48%, which is obviously higher than my 6.5 to 7 number. We've got a dividend yield of 2.07%, which is much higher than the current average yield on the S&P 500. The PE is only 13.37 blended, which means it's part past, part present in the next nearest forecast instead of trailing 12 months or future earnings. That's why we like the blended, because it allows you to get as close to an accurate reading of maybe what current earnings are as you can. And that simply illustrates, and I don't like to go out any further than this year's estimate and next year's estimate. We've got about a 25% opportunity over the next year and a quarter or so, which is very, very attractive for this company. Now, I also want to talk about analyst estimates a little bit, because there have been things like supply chain restraints and so on that have affected the company somewhat. But in spite of all that, I want you to note that their earnings growth really grew dramatically. Now, coming out into 2020, the earnings expectation 6 months ago was $3.48. But then as the COVID kind of went away and we got kind of a handle on what was going on there, analysts increased the estimate to $6.58, then finally into $7.30, and then the current actual turned out to be $7.74. But we see the same pattern happening as things became more normal. 6 months ago for this year, earnings estimates were $8.72, and there were 17 analysts making the estimate. Then 3 months ago, they raised it to $9.25, and now the most recent estimate is $9.56, which would be a 24% increase over last year's number. And then once again, we still have those same 17 analysts forecasting a 10% growth rate in 2022 to $10.50. Now, I don't like to go out any further than that, because note, for one thing that happens is you drop down to only 4 analysts when you go out further. So I believe near-term estimates are, the most reliable and predictable. But I also want to point something else out about these estimates while I'm in this aspect of the graphing tool here. Because, people always talk about being a backward-looking tool. It's not. It's as forward-looking as any tool could possibly be. Because, again, all we can do is forecast. We can only invest in the future. We can't invest in the past. So we have to forecast. So, I like to start with consensus leading analyst estimates. As I'll show you a little bit later here, they get their numbers typically from the company itself. But you've got 17 analysts that expect this company to grow 24% this year. The long-term growth rate, which is only one analyst forecasting this, from the data we get from FactSet, is for 7%. But I don't like to stop there. I like to check other sources. So, again, remember, the only thing about the future that's certain is it's uncertain. It is a forecast. As such, we have to be realistic. So I'm going to go to Yahoo, which gets their estimate data from Reuters. And here they have a next 5-year estimate of 15%. Okay, now this 7% estimate would give us, about a 9% annualized rate of return out for the next 5 years. If we use the 15% number that Reuters did, that number balloons up to 18%. So you kind of got maybe a mild case or a very conservative case, and then a very large case, both of them indicating positive rates of return going forward. Plus, remember the dividend growth record, because when we look at this company's historical performance, and I'm going back here till December 29th, 2000, when the stock was trading at $9.94. I take it up to the $121 it closed at yesterday, and my $10,000 would have grown to $120,264. However, because this is a dividend champion, the real value that I like about a stock like this is note that the dividend increased each and every year, average growth rate of 13.8%, compound average growth rate of 12.8 rounded. Okay, so that means the income increased. If you invested $10,000, you'd have got $251, then $281, then $311. By 2012, you were getting almost $1,500. By 2016, you were getting over $2,000. And last year, you got just under $2,500. It's currently averaging about $634, $633.96 a quarter currently. And they just did, maintain their 63-cent dividend. So that's, they're still on track, and they still have the opportunity to raise their dividend this year. But if you compare that to the S&P, they're $26,000 in income since 2001 versus only $4,692 with an equal investment in the market, makes a real advantage to Polaris from an income point of view. But their $10,000 was also a 10-bagger. It would have given you, 112,000. In other words, 10,000 grew to 122,000 versus 10,000 only growing to 35,000. 643 in the market. So that's a 14%, 13.9% versus 7, about twice the rate of return, but way more because of the power of compounding. The total return was 150,000 versus 40,000. So that's getting close to 4 times as much money. So this has obviously been a very good investment with a lot of volatility, but the predictability of their dividend has been what's most astounding. And I do want you to note this area below the white line is the payout ratio, and it was paying out, around 40% back then. Then the payout ratio actually dropped to about 33% when the earnings exploded, and it's currently paying out about 32 or 33%. You can see the payout ratios here in this column when you go back to the performance report on the fast graphs. Okay. Now, I've also liked to do some research on this company, give you some insights into what this company does. So I go to the external links and I click on the website. Oh, and this is Polaris, okay, and Polaris brands. They make off-road vehicles under the Polaris RZR, the Polaris Ranger, the Sportsman, and the General. They also make on-road vehicles with Indian Motorcycles, and they recently sold their Victory motorcycle, which was a brand that they had established a long time ago. That was part of the write-offs we looked at earlier. But they also own these other very interesting brands on-road brands, which I'll talk about a little bit later. They're probably best known for their snowmobiles. That's kind of where the company started, but they also make commercial, government, and defense vehicles. So they also make parts, accessories, and even apparel. So that's another portion of their business. So if I go look at their off-road vehicles and kind of going back through the brands here, you can see that they have some very interesting off-road vehicles for sportsmen and adventurers, etc. They also have side-by-sides and ATVs to fit your needs, as they call it, that, people use on ranching, as well as, using it for just going out for off-road adrenaline adventures, as they call it here. And, they're sportsmen, etc. So, the company's off-road vehicles are very interesting. Their on-road vehicles also, notwithstand the Indian motorcycle, they also have the on-road vehicles, the Indian motorcycle, the Slingshot, which is a very interesting 3-wheeled motorcycle. And then they have the Gem, which is electric low-speed vehicles. And then they have the Axum, which is a leader in quadricycles in France. And then this Goupil, which is electric utility vehicles. Okay, so those are some interesting, brands. As far as snowmoboards go, they have snowmoboards and snow sleds. I mean, they're just very well known for, these products. They've got some of the best brands, in the industry in those categories. But then they also make these commercial vehicles and even government and defense vehicles. So a lot of diversity here. They have the electric low-speed vehicles. They have the Taylor-Dunn vehicles that work, that can be used in warehouses. They have these government and defense, especially the lighter vehicles, the ultralight tactical mission vehicles. They have, defense for both police as well as government, fire and rescue, as well as law enforcement vehicles. So, you can see the company's brands are also, very well. They do sell accessories, apparel and things like that. So as you can see, it's a pretty diversified company in one aspect. Now, another thing you can do when you go into the company here, you can go into their investor services division, and this is their second quarter earnings presentation. And if you're going to invest in a stock like this, I do suggest that you spend some time looking at these presentations, okay? Because, you'll get a lot of information about the company. Now, last quarter, they had a very good quarter. They exceeded financial expectations. They talked about retail demand being very strong. Customer pre-orders were at all-time highs, and growth was continuing at great levels. And then they break it down into all the different categories. But this is an issue that I mentioned earlier that I would talk about. Like a lot of companies in the world, the company's facing some real issues with supply chain constraints, okay? Their inventory has fallen off a cliff, as you can see here, going into the second quarter of 2021. And you can see it by off-road vehicles, snowmobiles, and motorcycles. They've actually had some issues from the same quarter last year versus the quarter this year. So that's something to, you should all be aware of when you're looking at the company. But their business itself, as I'll show you here in more detail, is actually strong. Now, they talk about their capacity utilization in this presentation. I also want to point out that these presentations are what the analysts that I covered a few moments ago are getting their expectations of what they believe the company is going to do. And the company does give guidance on things like sales and earnings. Okay, so the analysts are watching, attending these presentations, and the companies tend to like to underestimate earnings estimates and guidance as much as they possibly can because they don't want to be surprised, in the downside. They don't want to say they're going to earn $1 a share and they only earn 90 cents. That usually causes a big drop in the stock price. They want to say they're going to earn $1 and earn $1 nickel. That's the kind of thing so companies do try to guide analysts correctly, I would say, but also conservatively. I think that's real important. Now, I do want to go into fund graphs here, the financial underlying numbers, and look at some things that I think are very, very important. The company's record of common shares outstanding, I think, is very interesting because I do want you to note that, like, for example, coming out of the Great Recession, they were actually issuing shares in 2011, 2010, from the low that they established in 2009. Now, if we go back and look at the company back then, if we look at 2010 and 2011, they were issuing shares when their stock price was high, trading at high valuations, and their earnings growth was very, very strong. Now, as far as when they were buying back stock, like back here, in 2006, 7, and 8, you can go back and look at, the fact that they were buying back stock pretty aggressively in 2006, 7, and 8 when the stock was cheap. I want to see a company buying their stock when it's cheap because I don't want them investing in their own stock unless I would, and I only will when their stock is cheap. And if they are going to issue stock, I want to see them issue stock when they're getting a premium for their stock. And I think Polaris has done that, really beautifully. Now, I do want to look at some things on their cash flow statement real quick. So I'm going to eliminate this here, and let's just go into their cash flow statement because the first thing I want you to note is that their free cash flow and their operating cash flow both are very, very strong, but most importantly, both of those are covering the dividend. Let me do this as a line graph so you can see it. This real aquamarine is the dividend, and then what you have here is their free cash flow and their operating cash flow, and you can see that they're covering their dividend, extremely well. I think that's very important. Another thing that I think I want to point out here about them is their balance sheet. If I look at their cash, relative, and I'm going to go back to this graph, I look at their cash relative to their debt, you can see that right now they're sitting on a very strong cash position, which they can almost pay off half of their long-term debt. Most of their debt is long-term, that's the blue line, compared to their total debt. So their balance sheet is pristine, in my opinion. It's very, very attractive. Now I'm going to close this video by turning to the new version of Fast Graphs because I want you to see some other fundamentals here. When you look at diluted earnings, I do want you to note that they had the charge-offs and the write-offs. They had the restructuring costs from selling the Victory motorcycles that I mentioned earlier. Then they had some integration costs from an acquisition they made of Taylor Dunn International. So they had, from a diluted earnings point of view, they did have a couple of weak years, but then their earnings were recovering on an operating basis. But I also think it's important to look at the company from, as I mentioned, operating cash flow held up very well during this period and was strongly covering the dividend, as I mentioned earlier. Free cash flow, as I showed you, was strong. Now, they did go through these charge-offs and the acquisition of which diluted their free cash flow for a short time. But you can see they've built it up very quickly. And then finally, if I look at them from Ebitda, you can see a very strong correlation between price and Ebitda. And right now, again, it looks very undervalued on that basis. And then finally, since everything, falls from the top line, if we look at sales, the company's sales record looks a lot better than their earnings records because of those charge-offs and some of those non-recurring charges and non-cash charges that I showed you earlier. But you also see here very clearly the real risk of high valuation, but you also see the great opportunity of low valuation. Anyway, this has been Chuck Carnevale covering Polaris. It's a dividend champion. As I mentioned, 26 consecutive years of raising their dividend, double-digit rates for the last 20 years, which is all my fast graph goes back. It's trading at, a very attractive valuation, under 14 times earnings. The last I checked today, the stock was down about 0.8%, down $1 today. I think this is a great time to be looking at this stock and possibly building a position for the future if you're looking for dividend income in this overheated market. The PE is under 14, earnings yield 7.5% probably after today's drop, dividend yield a little over 2%. Anyway, that's Polaris, the Dividend Champion. Hope you enjoyed this video and look forward to talking to you again real soon. If you like the video, give me a like, ring the bell, subscribe to the channel if you haven't already. But I do plan to do some more ideas like this throughout the rest of the year and actually throughout the rest of this week. Thanks for watching.